Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And I want to thank each of you for listening to the Make Your Money Matter podcast. And as always, to subscribe or download our podcast, you can go to our website at onecapital.com. You can click on the media tab and subscribe and download there. You can also download the podcast on any platform where you would otherwise download a podcast, whether that's the iTunes app, Google Podcasts, Spotify, or SoundCloud. And leave us a review, leave us a message. It's always good to hear from our listeners and our clients out there. For those of you who listen every week, normally, I talk about topics on more of a macro scale of things regarding planning, investment objectives, goals, how to align your emotions and your logic with your money and overall retirement planning, and everything in between. This week, I want to focus our attention into two obvious things that I know have come up for you in the past couple days. Number one, and this is not in any priority, but number one, I want to talk about Charles Schwab. I want to talk about the bank. I want to talk about the custodian. As each of you know, for those of you who are clients here at One Capital Management, Charles Schwab is a large custodian of ours. And for our retirement plan that we utilize for you guys through Voya, we use Charles Schwab. So I want to talk about the solvency, their stability and their strength and how it differs from the bank. And number two, and what the bulk we're going to go into today, is Silicon Valley Bank. We're going to talk about it mainly because I want to address a couple things. First and foremost, I think it's really important to bring this back up, is that in times like these, when you have something like an SVB situation happen like last week, you'll notice that there is a lot of fear selling. There is a lot of remembrance and I'll call it a hangover effect from things that you can glean that are similar but not the same. And you probably know what I'm talking about. There's a lot of rhetoric over the past 4 or 5 days that a bank failing is eerily similar, but not the same to what we saw in basically 07 into 08 and then really coming through 09. I'm going to address that. But I want to talk first and foremost about something because yesterday, in fact, Charles Schwab, the CFO, along with their regularly scheduled monthly activity report that we review every month as your investment advisor, but the CFO came out for a commentary, and there's a couple things that I think are really important as we talk about it. Now, before I bring up some specifics as to what he's saying, I want to set the tone here for a second. First and foremost, there is a difference between a custodian and a bank. And I want to address this very clearly. The assets that any client has with us or any firm that uses Charles Schwab as a custodian, their assets are not with Charles Schwab Bank. And that's important because the first thing you want to think of is the solvency, and obviously with banking issues, will that spill over into bigger banks like a Schwab or some of the big 3 or 4? And we'll address that in a second. But first and foremost, your assets that you have in a custodian are at the custodian and not the bank. That being said, one aspect of your account, which for our allocation, for our clients is right around 2%, is at the bank, and that's in the money market form. And I'll bring into some addresses why their bank is still very solvent and why they're very much in strength, but we'll talk about that. But I did want to be clear about that. And here's the thing, 2% of portfolios is way under typical $250,000 FDIC coverage. So first and foremost, I want to address this very clearly to us. Our clients are very insulated from what is going on right now with some of these smaller and regional banks. That's item number one. I do want to bring up a few things with regards to some questions to the extent around what's going on as it relates to Schwab and Schwab Bank. So here's what the CFO had to say, and I think it's important, so bear with me to hear this. The CFO stated a few things that I'm going to highlight here. Number one, Schwab has a broad base of high-quality customers across multiple lines of business, capital well in excess of regulatory requirements, a high quality and relatively small loan book, which is true, and a conservative investment portfolio that is 80% comprised of securities backed by the U.S. Treasury and various government agencies. He went on to say, we believe one of the best indicators of strength and stability of the firm is client activity. And as of February, their results show that clients entrusted Schwab with more than $41.7 billion in net new assets, which is their second strongest February ever, following our strongest January of this year. So that's important to note with regards to strength and stability of depositors, which we'll get into here as it relates to the SVB, which is a totally different situation. He went on to say as well, following the recent events in the banking industry, we are pleased to see the U.S. Treasury Department, Federal Reserve, and FDIC step in with decisive action to support depositors during this critical time. We think the steps announced today provide an additional layer of protection for individuals and will help boost confidence in the banking system. Now, he went on again, collectively, more than 80% of client cash held at Schwab Bank is insured dollar for dollar by the FDIC. I want to repeat that, 80%. Now, according to the S&P Global Market Intelligence, that percentage is among the highest of the 100 U.S. banks. Now, as a comparison, the banks in the news over the last few days, to give some reference points, have between 2% and 20% of their deposits insured. So, again, even though your assets, for anyone listening right now as a client or using out there Charles Schwab as a custodian, this is the bank side, and even the bank, they're 80% of their assets are dollar for dollar insured by the FDIC. Again, comparing to SBB banks or these other ones that are coming out that are 2 and 20%. So it's amazing to see the difference there. Now, last thing I'll bring up here on his comments, and again, it was a great commentary, is this. Schwab does not have any direct business relationship with Silicon Valley Bank or Signature Bank, so we do not have any exposure to any direct credit risk from either. This again coming from the CFO. And I think it's important just to bring that up. I know I've had some questions, and I think it's important because obviously you see Charles Schwab in the news, and even though this podcast isn't necessarily designed to be of news and nightly news discussions, I obviously want to take important aspects that come through the news as it relates to, again, everything that we go through with you, which is your investments, your retirement planning, and then obviously the emotional side of how this world operates with the market, especially with news and social media throwing everything at you and selling the fear. So first and foremost, I wanted to go through his statement there. I thought it was a good way he wrote it. We did some research on it as well, and there's a lot of solid data there as to describe Schwab Bank as well as Schwab the Custodian. All right, switching over for a second to SVB. I think it's important to understand what happened with SVB. We have to understand exactly how banks use the money we deposit. I think it's a start there. Normally, banks will take your deposits and lend it out so they can make money from your money. Makes sense, right? That's the game. It's completely normal. It's been happening for years. That's how we have arbitrage in this market. So as rates were low, which we saw for the past 15 years, but really low during the pandemic, Silicon Valley bought long-term treasury bonds and government-backed securities, which are deemed, again, quote unquote, to be safe investments. Okay, that I can understand, but let me go into detail on this. The challenge is, as we all can see, is when interest rates rise, because fixed rate bond values typically decrease, which led to significant losses for SVB. Now, to complicate the issue here, with interest rates rising, it's now more expensive for startups to fundraise. Think of, you guys watch Shark Tank, right? It's harder, it's more expensive to fundraise in a higher interest rate environment, okay? Which means for SVB, which is very much focused, as we all have read and seen, on venture capitalism and, alternative investments in startups, essentially, right? This means less deposits for that specific bank. So with less fundraising, many unprofitable startups had to dip into their deposits to pay for regular expenses, like no different than daily payroll, as an example. Now, as such, you can see very clearly through this just simple, I wanted to start at the beginning here, that SVB not being able to meet the deposit redemptions eventually signaled a cash liquidity crunch. This is where you heard the term a run on banks. Now, what I've seen with the news is saying these huge lines, and I'm not saying that that's wrong, but it was from a fundamental reason. It wasn't just like total emotional erratic fear. Now, it signaled a cash liquidity crunch and tried to sell their investments. So SVB tried to sell their investments to meet demand, then tried to sell themselves, as we saw middle of last week, in an effort to raise what they deemed about $2.25 billion, essentially to stay afloat. Obviously, this spooked some investors, and then they said, give me our money, right? Which is fine only if a few companies did that. The challenge is everyone said that. simultaneously. So in the finance world, they call this, as we saw in the news, a bank run, a run on the bank. So customers tried to pull out basically nearly $42 billion within a matter of a day, and eventually SVB ran out of money. They couldn't provide it. So the stock started to fall, as we saw on Thursday, and then eventually collapsed last Friday. So this bank failure, as I'm bringing it up, and I know it's of topical mind to every one of you listening here, and it makes sense, right? It sent shockwaves through the entire tech industry, domestically and internationally. And by the way, it's estimated that close to 65,000 startups could essentially miss payroll if regulators didn't step in, which we now saw that they did. FDIC took over SVB on Friday. And essentially, they said they will back all of the depositors' money, which again is a good thing.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Okay, that's the setup of the background. Now, many of you probably read this, and hopefully many of you know that. If you didn't, hopefully they give you some backgrounds of how a bank works and how this kind of came to light. One thing I'll share, and I actually just had a conversation with Steve Cowley, our Chief Investment Officer, my partner here at One Capital, and we were talking through this, and my first question to him, like many have asked, is this going to be a singular event? Now, obviously, there's going to be some spillover with how this is going to roll out, but you got to think, with depositors running their money, they have to put the cash somewhere. Not $42 billion of people, especially VC guys, are going to necessarily go and put it in a hole in their backyard. So you can see over time, again, this is an opinion at this point, right, that we're going to see some increase potentially in larger banks, or maybe a shore up of some things in some of the regional or smaller banks as well. So again, it's an interesting market. Now, of that $42 billion, here's some specific math. There was only $26 billion that was available to fund for the withdrawals. This was as of Friday. So that's how you can see when people want $42 billion and they only have 26 ready to go, that's how they fail. Now, this is to me, a problem of management just the same. Now, get this. This is what's crazy to me. And here's the thing. I will give them a pass on putting billions of dollars in 10-year treasury notes earning 1.5%, because basically when you put it in that way and you lock it up in 1.5% and you have a general rise like we saw in this past 12 to 14 months of interest rates, they got creamed. Okay, I'm going to give them a pass on that. What I'm not going to give them a pass on necessarily is the fact that venture capital firms and startups put $200 billion with them and they left it at the bank. The bank, there's no cash money management. So part of this, a good part of this, I should say, is just mismanagement and poor management at the bank. This isn't necessarily a systemic thing that's going to feel through all of the banks. Now, obviously, we have yet to see this. This is very live, but I wanted to give you some under the hood, I guess, fundamental analogy as to what's going on. And look, I hate to say it this way, but it's almost like you can't fix stupid. And I know that might sound crass, but, again, I give them a pass because they did put a large amount at least 1.5% earning 10-year treasury notes, but then they went over that and just left it at the bank in cash, not insured. I actually think that's mismanagement and just crazy. So when you have this kind of interest rate arbitrage that was happening, they did nothing with it to go try to earn to either outpace or keep up with inflation. So let me put a bow on this way. And this is actually some commentary from our investment committee meeting yesterday. And obviously this is a live situation, but I wanted to at least address it today on the show, okay? Our conclusions are this. There's no systemic banking risk. Regionals may struggle to hold deposits. I mean, look, let's just be fair. Depositor confidence has eroded and there's fiduciary decisions going on. There's likely to accelerate consolidation in U.S. banking. The big might get bigger, so there's something we got to look at there. Look, politicians have really a field day with more regulation, so we're going to see that play out. And our last conclusion is we might see some opportunities that we will look at our portfolios, look at the deferred comp plan that we're managing, and maybe look at big banks, financials, maybe even some regionals. But there's going to be some ideas there to see. Now, we have to let this play out, and we're seeing this kind of happening live. But more than anything today, I wanted to address those two things. I know it's come up, and I think it's really important that we address that as topical things like this happen. And if you're a client of ours here at One Capital Management, now is a great time to reach out. We'll be doing the same thing. It's a great time to go through any specific questions you might have. If you're not a client, I think talk with your advisor about this. If you're don't have an advisor, reach out to us. These are good examples of making sure that the noise that's out there doesn't disrupt you from the goals you have with your money. If those of you who listen to my podcast every week, the beauty of what we're able to provide, and any good advisor can do this, is accountability. And if they're worth any salt, they can provide some clarity into what the noise is being shared, right? Because most of us are receiving information in 140 characters on a Twitter feed or some, red bulletin at the bottom of a news channel. The reality is there's much more to it. And so what I want to share is, how we see things under the hood, not just necessarily of what's going on. And I think that's important as you put that into context to do the two things I always talk about, which is keep your discipline and make sure you also have discernment. And look, there's a difference, and I want to share this again. I spoke about this a couple months ago, and I had some comments on it, and I want to reiterate this. There's a difference between worry and concern. They sound like the same word, but they're actually not. Worry, you tend to focus your attention on items that you can't control. Concern, and by the way, worry usually leads you to inaction. Concern actually has more of a profound effect to lead you to take action, and it's okay to be concerned. It may not be okay, and it might be mentally not great for you to worry. Because if you're worrying, you're focusing your attention on items that typically you can't control. I have conversations like, hey, do you think we're gonna, go to war, and what will that do? And the reality is, and I hate to say it this way, but do we really have control of whether or not we go to war with God knows who, China, Russia, right? And that's just an example, a hypothetical. My point is this, is be careful to ask yourself and be candid with yourself about what you're worrying about versus what you're concerned about, and addressing those fears. And the concern, when it leads you to action, that's a great conversation to have with your advisor, someone you trust, someone that has credibility and knows what they're talking about in this world. Not necessarily someone who sends out a newsletter and you don't see their face, and they're writing these things on topical stuff and selling fear, and you're paying $9.99 a month for a subscription model. Maybe not the best place, just saying. Make sure you know the person. Make sure they know your situation. Make sure they know your goals and objectives and how you view money. It matters. And so we share that here on the podcast, and we believe that here as a core ethos of what we do at One Capital Management Advisors. I want to thank you for listening to the Make Your Money Matter podcast. As always, before you act on anything discussed today, make sure to speak with a financial professional near you. Or again, if you'd like our help, you can reach us at onecapital.com or give us a call. You can reach us at 805-410-5454. And until next week, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.